Pecuniary interest, either now. Hearing none. Delegations. We have a presentation of the 2016 audited financial statements, and Tracy Smith is here. Welcome, Tracy. So the floor is yours. So they have been circulated. These statements have been circulated. So actually, I'd let maybe Betty Ann do the introduction.
Okay.
Thank you, Mr. Warden, and certainly I'm pleased to have Tracy Smith here, the managing partner for our 2016 financial audit. And Tracy has provided a number of documents that have been circulated, and hopefully you had an opportunity to have a review of them, and Tracy's going to provide us with some highlights. I've also invited two of our team members from the finance division, Susan Petrick, treasurer, and Connie Hutchison, financial analyst, to join us.
Thanks, Betty Ann. I'd like to thank the committee for having me here this morning, and I also like to thank Betty Ann and Susan and Connie and the Treasury staff for all their assistance that they have provided during the audit. Also like to thank Mary Ann and her Human Resources team for the assistance that they provided during the audit. The report that you see on the screen with the lighthouse, as your auditors, we have the responsibility to communicate with those charged with governance. This report contains all the required communications under generally accepted auditing standards, and I'll provide just a brief overview. I will not read it word for word. We're going to provide a high-level overview of the financial statements that have been approved by the management team, and then there's an additional report with some financial highlights in a graphical format. If you have any questions, please feel free to ask me throughout the presentation. In the executive summary, we are required to confirm annually that we are independent of the county. Materiality amounts are material if they could affect the decisions of users relying on the financial statements. The materiality used for the audit was $1,715,000, and that was based on 2% average revenues, which is standard for public sector entities. We use this materiality to help us focus the audit and to provide us with statistical sampling. Because we provide absolute assurance, we can't audit 100% of your transactions, so we use sampling methods to make sure that we have enough evidence to support our opinion. As part of our ongoing communications, we are required to have a discussion about significant accounting policies, accounting estimates, and financial statement disclosures. Significant financial statement disclosures would include the accumulated surplus note in page 5 in the financial statements. This is the only place that you would find the operating surplus for the year, as the financial statements are required to be consolidated for under public sector accounting standards. The 2016 surplus was $1,578,529. The Director of Corporate Services did provide a report, I believe, to you last month that provided a detailed analysis of that surplus and where those amounts were generated by department. So we did not, as the auditors, recommend any changes to that surplus amount. Other significant disclosures you'll find in the financial statements are contingencies and litigation proceedings, and those are disclosed in Note 10, and commitments are disclosed in Note 14. Significant estimates that are involved in the calculating of the amounts in the financial statements are post-employment benefits and WSIB liabilities, and those estimates are provided with the assistance of an independent actuary. Other significant estimates would include the taxation revenue accruals and the liability for contaminated sites. Management is not aware of any contaminated sites, so there is no liability accrued in the financial statements for December 31st, 2016. We are, as your auditor, required to disclose to the committee if there are amounts that could have been adjusted during the audit, and we are not aware of any differences. There are no unadjusted differences from a result of the audit. Management representations, we rely on management representations as part of our audit evidence, and a copy of that management letter is or that management representation letter is included in Appendix C. Internal control matters, as your auditor, we are required to report to you, the committee, in writing if there are any significant deficiencies in internal control that we have identified during the audit, and during the course of the audit, we did not become aware of any significant weaknesses that should be disclosed to you. Fraud discussion, we've just come out of in-camera session, but we are not aware of any actual suspected or alleged fraud. If there were any issues or concerns, if you would contact me directly, please. That concludes the required communications. Is there any questions before we move on to the actual exciting part of the numbers?
Only an accountant would say that. Any comments or questions? Okay.
Okay, so following along in your package, you'll find the actual financial statements. Our responsibility as your audit, oh, no, you're too far. Yep, still in that one. Our responsibility as your auditor is to provide an opinion on the financial statements prepared by management. So the financial statements are prepared by management. An audit is the highest level of assurance we can provide. And you'll find on page 3 of our audit opinion that we believe we've obtained sufficient and appropriate evidence to provide a basis for our opinion. And in our opinion, these financial statements are presented fairly in all material respects in accordance with public sector accounting standards. So that means there's a clean opinion. There was no materially misstatements in the financial statements. On page 4 of the actual audited statements, you'll find the statement of financial position. This is a snapshot in time at December 31st, 2016. The financial assets at December 31st totaled $31.7 million. Of that, $29.3 million is in cash and temporary investments, so the county is in a very strong cash position. Of the $29.3 million in cash and investments, 24.4 of that is held for in reserves. Liabilities at December 31st totaled $37.8 million. There was an increase in the accounts payable and accrued liabilities over the prior year, and this really just relates to the timing of the provincial programs. Some of those funds are flowed ahead of time. So there was almost $1 million that had been flowed in advance that will be subsequently recovered or spent. There was some significant capital projects also at the end of the year, which caused the accounts payable to be higher than it had been in the prior year in the social housing department. We talked about the estimates on the financial statements, and you'll find those in the WSIB future benefits and the post-employment benefits amounts. So those are liabilities that are based on actuarial valuations. During the year, the county repaid $2.4 million in debt. So the long-term external debt owing by the county is $24.2 million. We then come down to the net debt that's on the financial statement. So that is the financial assets less the liabilities. The liabilities were higher than the assets, so that means that the county is in a net debt position. So the county does need to raise funds in the future to pay for resources that have already been incurred. The the non-financial assets include the most significant asset of the county, the tangible capital assets. So that includes the roads and the infrastructures and all the tangible assets of the county. That is recorded at cost less amortization. And finally, you come to the bottom, which is the accumulated surplus. So this is the surplus that's been accumulated over time, which includes both the monetary assets and the fiscal tangible capital assets. Okay. On page 5, you'll find the statement of operations and accumulated surplus. So again, this is a very high level, a very condensed, consolidated summary of the transactions for the year. The revenues include all of the external revenues, including those revenues that are generated for capital purposes. So operating capital is all included in these revenue amounts. It does not, however, include any revenue that is being brought in for transfers from reserves. The expenses include all the operating expenses and also includes an estimate for amortization. So you'll note that the budget numbers in the first column for expenses are lower than the actual amounts in the second column, and that is because amortization is not included in the budget amounts. The county includes transfers to reserves to budget for future capital expenses and replacement of those capital assets. There is a comparison of the budgeted expenses to the actual expenses without the amortization in the financial report that we'll look at in a minute. The annual surplus is $4.3 million. So this is the net revenues that are raised externally after paying all the operating costs and covering the amortization. What's important to note about that number is that's not your operating surplus. From this $4.3 million of external revenue, that's net external revenue that's been generated, you now have to pay for your debt payments, and you also have to pay for actual capital purchases during the year. To adjust for those capital purchases and the amortization, we go to the next statement. So we take that $4.3 million annual surplus, and we adjust for capital assets and amortization, leaving a decrease in your net debt of $3.7 million. So that $3.7 million is then used to pay for your principal payments and also to set aside money in reserves for future capital purchases. What's important to note on this schedule is an increase, a positive number or a negative number. A negative number is not necessarily bad. What you would do is compare what you actually budgeted for. So you budgeted for a negative $7.4 million, so that means you were going to use a significant amount of reserves coming out, and that was what you had planned for in your budget. You didn't have to because your capital expenses were significantly less than budget, and you can see that you'd budgeted $20.7 million for the acquisition of tangible capital assets, and you only purchased 14. So that's why you budgeted to come from reserve, and you ended up having money to put in reserve, if that makes sense. Any questions about that? Yeah. I'm not sure. I don't know how to. It's really difficult because these public sector we don't have a choice on the format of these.
Unfortunate.
Unfortunately, everything's consolidated together. And the real purpose of that, and the purpose of why that's presented this way for those charged with governance is to look at the big picture. So instead of focusing just on the operating surplus, which is very short-term, looking at the tax rates on an annual basis, the financial statements are prepared on a consolidated basis to try to make you look at the big picture and also forecasting for the future and the long term.
Well, Tracy, can you tell me then what led to that difference, that 20 million and 14 million? Like what? It came out, we didn't take other reserves, you said.
Yeah.
So was it just not spent, or was it, we just didn't find that $7 million or $6 million?
No, you will be spending it. There might have been some projects that you deemed weren't needed, but in a lot of cases, those projects will go forward in the next year.
Incomplete projects is basically, and then they would be transferred to complete in the following year. It's not typically that we found revenue from other sources. It was just we intended to do a certain amount of capital work, and we weren't able to meet that for various reasons. They were deferred, and in many of those cases brought to the various committees' attention as to why those capital projects would be deferred, but the reserves would still be in place, or the revenue in place to complete them in future years.
Seems like a lot. Is that normal? I can talk to you.
We can, but typically that has been a trend for the last few years, is with our capital. I think and certainly something that we've been managing, and with our new capital template that we'll be introducing for 2018, you'll be able to identify that more clearly.
Thank you.
The last main statement in the financial statements is a statement of cash flows. So it is on page 7. So this is a record of the actual physical cash in the cash, the bank accounts and the temporary investments. So kind of halfway down the page, you see that you've generated 18.7 million in operating cash. You spent 12.8 million in capital transactions, and you repaid $2.4 million in debt, which left a net change in your cash position of an increase of $3.4 million. So overall, the county is in a very strong financial position. You ended the year with a $1.5 million operating surplus. There's strong cash flows with, you've got 2.9 million in cash and cash investments, of which 24.4 million of that is held in reserve to plan for the future replacement of your capital. So overall, a very strong financial position.
Thank you, Tracy. Questions, comments?
The last report is just a graphical look at some of the numbers and taking some of the numbers in the consolidated financial statements and pulling them apart. As I said before, Betty Ann had provided last month a very detailed analysis of where the surpluses came from. On page 3, we just again look at some of those key financial indicators. To be financially strong, you need to have cash and cash reserves. Your long-term debt your external long-term debt has been decreasing over the last 5 years. Back in 2012, you had 31 million. Now you're down to $24.2 million, paying off an average of 3.7 to 3.9 in debt and principal payments over in each of the 5 years. Again, your net financial debt position, that was the assets less the liabilities that were on your balance sheet. In your case, your financial liabilities are greater than your assets, but again, that has been significantly decreasing over the last 5 years. That is one that you'd like the trend to see going in a decrease of the negative number or an increase in a positive number. The accumulated surplus that was on the financial statement is broken down for you there. Things to note in the accumulated surplus is unexpended, unfinanced capital is 2.2. That's really just one project in the social housing that was financed by debt and is now and is being repaid as the debt is being repaid. The unfunded, the post-employment benefits in the WSIB, although they're recognized as liabilities on the balance sheet, they aren't funded, so those only come into your budget, into your operating budget, as they are actually physically expected to be paid out and are paid out. And again, $24 million, so $24.4 million in reserves. So then we have a graphical look at your cash flows. Again, strong cash flows. The next page is your tangible capital assets. It breaks it down by the types of capital assets that you do have in your county. The orange part in the middle is the roads and bridges and other infrastructure, so that is a very significant portion of the type of infrastructure you have and that you have to look at maintaining and replacing. And you do have a significant amount of buildings also, and it's the red part in that one. Can you just go to the next page?
I can. I just want to, we'll recirculate that one and repost it. It appears that in translating it into the PDF document, we lost some numbers on the top part there, so I apologize for that. We will get that corrected.
Okay. So again, this was talking about the type of assets you have. On the next page, we look at the purchases versus the amortization. So for accounting purposes, you're required to record. So for accounting purposes, you're required to report based on amortization, which is an estimate of the use of the asset over time. So if you have a vehicle that costs $10,000 and you think it's going to last for 5 years, then $2,000 would be amortized over the 5 years, and then at the end of the 5 years, you would have raised $10,000 to replace the asset. Although that doesn't work exactly, because the $10,000 vehicle that you purchased 5 years ago is probably not $10,000 anymore. So there is a lot of planning involved to make sure that you do have enough funds for those replacements. But it's the best estimate that that can be verified. So that's what the accounting standards have used. In terms of governance, the challenge would be to try to make sure that the purchases are at least equal to the amortization, because as we discussed, the amortization is a very conservative number, so you would want to try to replace those assets to make sure that you're maintaining your infrastructure. So you'd like the blue graph to be higher than the red graph. The blue bar is higher than the red bars. The next page just looks at your revenues and where your sources of revenues come from. And again, this is consolidated, so this does include operating and capital. 49% of your revenues come from taxation. And a significant portion of your revenues still do come from government transfers of 38%. That's kind of unique to the upper tier, because the upper tier is still receiving government transfers, which it's not just capital grants, that's mainly from your social services programs, your social housing programs. A lot of those expenditures are funded by the provincial government still. So if you compare that to a lower tier, the percentage would be very much smaller. Page 8 just does give you a comparison of your operating expenses. So we've pulled out the amortization so you can compare the budget numbers to the actual numbers. And it excludes the unfunded post-employment benefits, and it doesn't include any capital. So we've kind of tried to strip that down a little bit so you can see the trends in the departments of the county. Now, these departments fall more along the lines of what's reported for the financial information return to the province. So it's not necessarily grouped the same way as the reports would be that you get from your management team on the departmental surpluses.
Sorry, go ahead, Mel.
So this is the graph you were looking at, right? Is there a table you were looking at?
Yep, that's expenses, okay.
So assistant.
We haven't got there yet, but,
Oh,
yep. No, we're on it now.
I'm patient.
Yep.
Okay.
So-
Okay, I just lost. So anyway, you have it there.
Yep,
Assistance for the aged, 27%.
yep.
So
So
does that mean our contribution towards long-term care or?
in terms of operating expenses, the county has a very significant portion of their operating expenses goes to long-term care, yes.
So, but when I look at roads at 9% and that at 27%, it's both excluding capital.
Yes, yeah. So you would think, in terms of the roads, you do spend a significant portion of your capital on roads, whereas for operating purposes, you wouldn't have as much capital for homes for the aged. A lot of that is in salaries to maintain the homes.
Interesting. Right. It's an interesting chart.
It might be useful maybe next year if we could do one pie graph for your capital to show the departments on where the capital falls out, and as you expect, you probably would see a very significant portion of that capital being spent on the roads.
Good, thank you.
Okay, and then the last page looks at what you have for the future and your reserves and your reserve funds. So there's $24.4 million in reserves. A significant change from the prior year is that $1.5 million of operating surplus has been transferred to the tax stabilization reserve, and I understand there is some discussion on what to do with that. So. Okay. Any questions?
Any questions for Tracy? Well, thank you very much, and I want to thank Betty Ann and her team for all the hard work too, and it's always nice to have a surplus, that's for sure, and I think we'll find a way of spending that possibly, Tracy, so we always do. So, did you have anything else, Betty Ann?
I know nothing further to add. There is a report and the recommendation to receive and accept them for information. And as that report did indicate, what the surplus has been transferred to the tax stabilization report, and then a report will be forthcoming to your June committee meeting, just providing an analysis of the activity and some recommendations moving forward.
There is a staff recommendation. Do I have a mover and seconder? Robert and Mike, are there any further discussions? Hearing none, all those in favor, opposed if any, that is carried. Thank you.
Thank you.
Tracy, what did you say?
Did we want to break for lunch? Okay, that's fine. All right, action items. vacancy rebates.
So a number of new tax policies. This is one of the beginning. We'll be having more discussion in June, and I know your local treasurers are tearing their hair out, as I am as well, as some of them continue to come. Just most recently, one on multi-residential, the tax ratios. We're still dealing with the landfill tax ratios, so it may mean some delay, unfortunately, in getting out those final tax bills. But I guess if there's any sympathy, and we're all vote together, so throughout the province managing with these changes. But this is the one on the vacancy rebate. We had a little bit of discussion earlier on. I've provided you with some background, some detail, spoke with your lower tier treasurers, and I think that just even that, having the discussion with our group, raised the level of awareness and just the need to really make sure that the eligibility requirements are met in all cases. And so that was the first step that we wanted to recommend. So not recommending any changes at this point, and revisiting the program in 2018 with your lower tier treasurers and bringing it forward as if there are any recommendations at that time.
There's a staff recommendation. Mover and seconder. Moved by Mike, second by Milt. Discussions? Yep.
Inspect these places when they ask for that?
Well, we wouldn't at the upper tier, but that's the mixed message,
What
I
we
think,
do?
that we were hearing when I met with the lower tier treasurers, that it is, perhaps we can do a better job at doing that. And then when we receive the application, that we are actually inspecting it, and we're taking a look at it again in maybe 2-3 months. So it is going to be a capacity work for someone on your staff to do that. But when it says it is completely unused, that does not mean that you're using it for your own private garage, that your storage. I mean, it is vacant and it is not being used for anything. And I think perhaps that interpretation in the past has maybe been a bit different across the board. So if they're using it for storage, then it is still classed as being used. So
You kind of put staff in an awkward situation, I would say, if you do have to go out and look at these things. No.
there certainly seemed to be a lot of uptake from the group that I had met, that they could see where there really was a need to do that.
Milt?
Yeah, I found this report interesting, Ben, and then you added that report at the end, where you included the numbers for each municipality.
Yes, and just keep in mind that those numbers are what the numbers that were provided for the upper tier portion. So that's only the upper tier portion. So if you were looking at your municipality, that was just the upper tier portion, and then you would have the portion that would be the education, and then the lower tier municipality. So your local treasurer would be able to provide you with that data, and I would offer that it was probably at least, certainly at least that amount, and probably double in some cases.
And I think the awareness right now between Stellina and Bruce Power getting out there and talking to the municipalities about what's out there for inventory, I think could help this a little bit too. But I have heard people saying, you're subsidizing vacant commercial buildings where I'm paying full taxes and just trying to get by on my business. So that's out there. And
And that discussed, and certainly with that that division as well, working on it with Stellina's team, that believe the lower tier treasurers just thought if we revisit it in another 6 months, that maybe there's opportunities and maybe there's some flexibility that we would want to add. Again, we would do it together as a group, because right now at the county, then we can determine, does it require to be listed in real estate? Does there have to be a sign on it, and some of those things? So there were some really good recommendations came forward, but we want to be able to manage it first and see if maybe it isn't, if we manage it together, maybe it isn't necessary.
any other discussions? All those in favor? Opposed, if any? That's carried. Budget amendment, staff recommendation, mover and seconder. Jacqueline, Robert? Nothing really further to add. All those in favor? Opposed, if any? That's carried.
There are a number of information items, and I can certainly go through them, or if they are just for information, if you have a specific question about any of them, I'd be happy to answer those.
Any questions or comments for any of those action items?
The information.
Sorry, information, sorry. Hearing none, I guess we're good. That was it, wasn't it? Motion to... Next meeting, next meeting, June 1st. Motion to adjourn. Paul. And Robert, thank you. All those in favor? That's carried.